we've been having the same pool of buyers fundamentally since 23. Those people are slowly buying houses. So it's going to just keep getting smaller and smaller and smaller and smaller. And I don't think it's replenishing at the same rate. What's going on, guys? Welcome to the Collecting Keys Real Estate Investing Podcast. So, Dylan, here we are at the middle end of July, and things are starting to get interesting. I think nationwide, real estate wide, everything's starting to get pretty, I don't know. Who knows? We have like the midst of the Epstein stuff going wild. You know, we have all of the talks about the interest rates and the feds and, you know, are they going to lower rates? Will that actually affect mortgages and everything else? But then weirdly enough, I feel like almost all the people that are winning in real estate right now are the residential folks, you know, us included in that. Like everyone that I know that's stuck with their residential business, despite the cooling housing market, seems to be doing pretty well. So I guess looking at how things have been going, I mean, your Q2 is really, really solid. You have your notes up here. What are you kind of seeing like big picture wise? Is this year, has it been worse or better than like last year for you? Like in terms of like revenue and just
revenues, we're ahead of last year. Nice. And the profit per deal is also higher. I contribute that to taking more down than the previous year. I will say that we only did 9 deals in Q2, which is a little bit lower than our average. So the volume wise is about the same as last year, but the revenue is a little bit up, and that's mostly because we did more flips and hold tails versus assignments.
Yeah. Well, which is also interesting too, because we've also had this movement towards more like flips and hold tails, which is honestly is kind of counterintuitive to how the real estate market's been.
Right. Well,
because we'll get into slow, allegedly.
Well, we'll get into it. My Q3 right now. I have a couple stuff on the books. Like there's about 100K in accounts receivable, but to be honest, like I'm not super happy with like current deal flow. My cost per deal is definitely going up. Cost per lead's going up. My latest round of mail, like it feels like crickets.
Yeah.
So
oh, really?
I don't know what's kind of going on right like at this very moment.
That's interesting. Because I would say like this year more than last year. So our lead flow is definitely down, but our deal flow from that is significantly higher. Like our efficiency of our marketing and like the number of leads that we're requiring to get deals right now is improving a lot. So like even right now, our current cost per deal on direct mail is $2,400.
Yeah, it's great. Which mine's $2,427. So like we're right on track.
Totally. But like last year, you know, we had a larger operation, a little more waste going on, but we were pushing 3,500 on average. And then even if you go back years ago in our market here in Eastern Washington, if we were doing good, it was about 3,000 to 3,200. So we were vastly beating like our historical averages with that. But our cost per lead is almost double what we normally would see, right? So our cost per lead on everything is about 280 for direct mail, 240 across all channels, which typically we were looking at about 140 to 150.
That makes sense. And I would just contribute that to your guys' probably follow-up process more than other people's. That
is such a huge thing too, which I always do explain to people. I mean, even this past, what day is it today? Thursday, recording this on Monday this week, we got a deal that it's been in our system since February, right? And the thing that's really funny about this one is, so our VA lead manager, who's a rock star, she locked it up because like, we were traveling, different stuff, like half the team's been out. You know, our main sales guy, Cody, has been in Europe. And so when Cody walked this property 5 months ago, it was such like a cool deal. He only took like 5 photos. Like it sucked. Mm-hmm. And so when Jessie was following up, she kind of saw like the conversation where it was at. She saw that they were at like 250 and she was able to run like a quick scenario. And she was like, it's like, I think if I told them between 180 and 190, it's probably a deal. She's been around long enough to just know that number makes sense. And sure enough, she got them to approve a 187, 500, which was based off of just like Cody's like 5 photos that he had, and got it signed. You know, and we had to send somebody else out there again to get proper photos. I'm probably sell it for either like the low 200s, 205, or you might just wholesale it for like a 270 exit. But the point of being is over the same time, they've talked to a lot of other people, right? Like back when we talked to them back in, February, they were talking to everybody in town. And then when we followed up, they were like, oh, we kind of had stopped talking to all you companies because we hadn't heard from anybody. And so we were the only ones that were left there.
It's amazing. A lot of people think that, they send out direct mail and you have to get that contract on that first call. That hardly ever happens.
It never happens. Yeah.
And if it is, they're like the lay down leads that hardly, or once in a blue moon. There's one that I was just talking to right before we hopped on here that I walked back in July of 2023. And she's got hit like every month for a while. And she finally just responded to my VA. And now we're set up to, as soon as we jump off this podcast, we're gonna have Tony, my acquisition, and then myself call her back. So
nice. That's awesome.
It's just stuff that, right?
And you get compound interest, right? Because those are the ones from 2 years ago now, right? And then the ones that you're mailing today might call you 2 years ago, in 2027.
Yeah.
Right. And it just continually starts to build up. Right. And so even if I look at, I have our KPIs pulled up right here. So half of the direct mail leads that we've gotten so far in July, because I do tracking campaigns based off the different kinds of mail we send. Half of the ones we've gotten in July so far are actually for mailing that we sent out in May. So there's a 60-day lag before they even make the decision to call us.
Yep.
And so you have to just keep doing it for a long time.
And that's the thing about mail is that you'll get calls a couple of years ago, I've held on to this for a couple of years, where with cold calling or PPL or texting, if you don't hit that lead keep hitting that lead, they're not going to call you back. There's a stickiness, I guess, to direct mail.
Yeah, there is for sure. I mean, and that never really goes away because the next of kin finds letters in grandma's house after she dies, and it's pinned to the fridge or whatever. Yeah, and they give you a call. But yeah, go for it.
I was gonna say fucking cut this out.
Fix that, Max.
Yeah. No, I was gonna say our return on ad spend was 900%. So it was still really good.
9x, that's sick. That's huge.
Yeah. So that's better than last year too. So, but to me, that just says, okay, spend more. But at the same time, it's with how I kind of feel our market's a little bit turning, and I don't want to I'm less pressed to take title in Q4 just because seasonally it's slower then. So I still battle with the decision. Okay, do you sign more? Do you take stuff down, mechanize revenue? I don't know if there's ever a perfect answer.
There isn't, right? I think you just need to get slightly better deals, expecting to hold the property for 3 or 4 months longer, right?
Yeah.
On hard money. Yeah. But I mean, the challenge is though, like you said, is the kind of cash piece with it, because you end up with a lot of projected revenue that, forecasted, right? Stuff can change on that. So if I look at our year right now, currently half of our revenue for the year is still projected, pending revenue, because it's all tied up in hotels and flips that we've been waiting to sell.
Right. Managing that cash can be tough. I've had a lot of cash go out lately, and it causes some anxiety. And look, the only thing that keeps me sane is going back to the numbers and be okay, this is what's coming in. These numbers should be rather accurate, barring some unforeseen circumstances, but it's still you might need to pull lines of credit or something in the interim.
Yeah, exactly. And having the ability to float that is a really, really key thing. And it's also why I think people that are debt averse should not get into real estate in general, because whether you're a real estate agent or you're a wholesaler, you're a flipper, the cash conversion cycle is very long. Yep. It's not like selling widgets where you get paid the second someone swipes their credit card. So do you know about all this stuff that's going down at the end of September? I'm assuming that you do, with how all the COVID forgiveness for everything on debt is going to be ending at the very end of September.
Correct. Yeah.
Yeah. What are your thoughts on how that's going to affect your business? Are you planning to do anything for it? And so for people that aren't aware, there's all these COVID relief programs and everything from mortgages to student debt to, I think there's some medical stuff that's in there. There's a bunch of different things. And I did a YouTube video with John Brooks that actually came out this past Tuesday. I'll put the link in the show notes. It was pretty well received. Actually got 12,000 views in the first day. But we dove into this quite a lot. And I'm trying to remember the exact numbers, but basically the amount of people that participated in these relief programs, it was 30% of them are currently expected to default at the end of September, right? And that 30% represents around 10.5% of all consumers, debt holders in the United States, period, which is extremely substantial, because the whole 2008 crisis, right, that was tipped off by a 2.5% default rate. And so we could be looking at almost 5 times that, 4 times that, right? And one of the talks right now is, well, A, what's that going to do bigger picture to the economy, but also in our business, we have an opportunity when that happens, but we also hold a lot of risk, because if that starts to negatively affect real estate values, we obviously don't want to be stuck holding the bag. So are you anticipating that at all? Are you doing anything for that?
Well, the way I would view it, kind of like the two-prong approach that you just mentioned. One is, the reality is, if people come distressed and they have equity in their home, that is an opportunity for us sometimes to capitalize on that. Mm-hmm. Because they need quick cash to cover some things. And student loans you can't file them out of bankruptcy. Like, they stay with you forever. My understanding is, once they're declared delinquent on the credit reports, they're not 30 days late, they're 90 days late already. Mm-hmm. So it's already kind of like they're really behind.
Well, and not only that, but the debt's been compounding, right? Because it's not like a forgiveness program, or it wasn't like they just paused it, but they were taking the unpaid payments and they were adding them principal and interest onto the end of the loan.
To the tail end. Yep.
Yeah. And this is for the real estate and the student loan.
It's going to come to a sticker shock for a lot of the people that we've even seen, like, what do you mean I own 30 grand more? That, deals fall apart the last second.
We had a deal like it was supposed to close last week, actually, that the lady was expecting to have enough money to go and buy a house. She was actually under contract to buy a flip from one of our competitors here, right? And then instead of getting that money, she actually found out she's going to have to bring $8,000 to closing, right? So she went from making probably 50 grand to having to bring $8,000 to get out of it. And now she's completely screwed. And like, the way the deal was, it was already pretty tight.
Yeah.
So there wasn't really a lot we could do.
Not to get too off track too, but I think a lot of the lenders are going to be, at least at the beginning, like, well, we'll take it. You have plenty of equity. We'll let it go to auction. Like, because they think they're going to get 100% return on their capital. They're not going to do short sales right off the bat.
No.
But so the other side of that is, we sell to a lot of first-time home buyers. Mm-hmm. Even if they are conventional, it's still the first time or the second time they're buying a home. So your buyer pool of who's going to buy your flips is probably going to get diminished as well.
It is, for sure. And that's something else too, that I've been thinking about this recently, because we've been in the same, I would say, like, real estate environment for since 23, late 22 now, where prices have been fundamentally similar, maybe dropped like a little bit. Some places like Florida, Austin, they've dropped a lot, but most of the country hasn't experienced that, right? Interest rates have stayed the same. So you end up with this affordability issue with rising inventory, right? But there's also this current situation right now, I've been reading about this, where if people can't sell their homes because they have low interest rates, they're just not selling at all, right? So you've seen less people taking low offers and less price drops, and more people just being like, actually, I just won't sell. And so what'll happen, especially as inflation grows, is we've been having the same pool of buyers fundamentally since 23. Those people are slowly buying houses. So it's going to just keep getting smaller and smaller and smaller and smaller, like the people that can actually afford to buy or have an interest to buy, period. And I don't think it's replenishing at the same rate. Like, there isn't like all these new people that are suddenly crushing it and want to be a homeowner, especially if they've been watching kind of a hairy house market for the last couple of years, And so we're kind of all competing for like the same pot right now that is getting emptier by the day as people do buy homes.
I mean, I do know that every seller I've talked to, and I think I'm pretty good at speed to lead, has already talked to somebody.
Every time, dude. Never fails.
And so we can still get deals done, but if those people, my point being is, your competition right now, at least mine, I hear some of the offers that they're giving some of these people, and I'm just like, you should take it. Because there's no freaking way that I'm going to be even come close to that. There was one yesterday that I offered 145. She's like, oh, I have one for 178. I'm like, okay, I'll talk to you in 2 months, probably when they don't buy it.
Well, that's a whole other conversation, right? Because that's still people that are falling for the guru bullshit of, lock up high and then price drop right before. Or
Sure. I just feel like there's a lot of it right now, where a lot of my offers have been, I feel like I haven't really changed my underwriting all that much to reflect the conversation that we're having. And I'm still getting priced out a lot. I don't know, Mike, like I haven't really thought that far ahead. I was more thinking seasonally adjusted for like Q4 just being slower to be more conservative. But the fact that this comes up in September, which is around that same time frame, would even, cause me to even be more conservative.
Well, totally. Right. Well, it's always tricky because there's these headlines and kind of these impending things that you can always kind of try to predict, right? But once it actually comes, you never know what the outcome's going to be. And the people that are over conservative tend to miss out, and the people that are over aggressive tend to lose, and sort of like, how do you stay in the middle?
You'll appreciate this. There's an acronym going around in political circles called TACO, which stands for Trump always chickens out.
Yeah.
And so my point being is that if shit starts hitting the fan, if people can't afford houses, if bankruptcies and foreclosures start skyrocketing, I do think there will be intervention, because history is, at least the past 20 years of history, have told us that they'll do something to ease the pain. They're very good at kicking the can down the road. It's just, we don't really know what that is. And then once those, whatever they decide to do, once it takes effect, how long those effects take to actually pan out.
Yeah. I mean, there always has been historically, right? I will say that this administration is probably the first one that, at least to me, it seems like is more than happy just to let things burn, right? Like, we've already had some stuff that's gone like so awry, and how they've dealt with some of like the higher profile situations that have happened, most recently, like these floods in Texas, right? Which is just a massive tragedy. And instead of like addressing the situation or even like making a statement, they all like fucked off on vacation. They were like pointing fingers at each other, like just doing stuff that doesn't really make sense, right? And I feel like they might do the same thing, whereas if stuff does collapse, instead of it being, like, do we kick the can? It would just turn to like, how do we point this at the other party and make it so it was their fault, and use that as like a excuse to try and like build more rage with their following base, which is how they've sort of found power.
Maybe, but I guess the tariffs are actually a decent example, where he's like, we're going to put all these, tariffs on these other countries. And then now pretty much they keep getting delayed and delayed and delayed. And I think that's just because, I think he's saying like, I can't play hardball forever.
Yeah.
Right. And I do think, Scott Bessent, Howard Lutnick, the people that surround Trump, even though he tends to do his own thing every once in a while, they're gonna be like, bro, we got to do something. And he's always calling for the firing of Jerome Powell, which I don't think is going to happen.
Well, he can't. Like, technically, it doesn't have the authority or power to do that.
Correct. He doesn't. It'd have to be an act of Congress. But his reelection's up relatively soon. Yeah. And so are they going to replace him with someone who's technically more dovish, or who is a yes man, who was going to do like these, 300% interest rates declines, which the Fed is supposed to be independent. So we'll see what that if actually happens or not. I don't know if we're just like rambling now, but I guess my point being is I don't think they'll take pain. I don't think they'll point fingers and be just like, I think they'll actually intervene. I just don't know how.
Yeah, for sure. And I think that's kind of the challenge, right? Is in this conversation, we've said maybe a bunch of times, and I don't know if a bunch of times, right? And that's how it's hard to like fully predict, something that's going to happen and adjust your business accordingly. But at the same time, I also think it's important to be aware, right? And at least be into a position where you're not over leveraged and you're not like facing a situation where you could get cooked if stuff gets bad. I mean, honestly, it's very similar to when like COVID stuff started to get bad and like the interest rates first started to go up. What I was seeing a lot of, actually, this is during the Silicon Valley Bank thing, was when it started to come out a lot. A lot of the really rich guys that we know, they were like just pulling all their lines of credit and everything just out of the bank right away, with the theory being that if they're completely leveraged against you, they're probably not going to call you due because they're going to be afraid that you don't have it. Mm-hmm. Right. And they're worried about if it was not being utilized, the banks would want their money back. Right. But I'm giving that example because they were in a kind of defensive position where they're like, that's something that they can do very, very quickly. That gives them some kind of security. And I think if there's any sort of uncertainty in the market, that's what you should do. Right. So like if you have like stinker properties that you're holding on to that you're waiting to sell, probably get rid of those ones. Like be buying houses with extra margin. Right. Yeah. And if you have like any funny loans, adjustable rates, those sort of things that you're still sitting on, you should refinance out of those ASAP, even if it means you're going to be losing cash flow, which is a false metric anyway. Right. Because what you don't want to be is going into something where all of a sudden you can no longer get refinance loans because, the banks aren't doing those anymore. Like that happened in 2020 in COVID. I remember when all of a sudden you couldn't refinance anything because the banks were like, we're not issuing debt anymore for like 6 months.
Yeah. Yeah. And honestly, even get good relationships with maybe a local lender too, because they might be more likely to be like, okay, we know you, we know your book of business. Yeah. They might issue you a loan when a JP Morgan or a Wells Fargo is gonna like get fucked.
Yeah, totally, dude. Yeah. Or like if you're trying to reach out to these new banks to establish a relationship and all of a sudden you appear from the woodwork to talk to them when stuff's getting weird. That's like a red flag for them.
Yeah.
Right. Like we've never heard from you before. And now all of a sudden things are in a complete downfall. And now you're hearing from us trying to, make face and get a loan. Like they don't typically like that.
We have a deal right now, Mike, where the seller bought it at the end of 2023 for $485,000 cash, which is a higher price point in our metro market. He got into some financial trouble. He sold it to me for $390,000. In that 18 months, he'd put on a brand new roof and added a heated indoor pool in the back. Nothing really else had changed. We have it listed for $489,000, so just $4,000 above what he bought it for. Literally, I have like 2 showings.
Nice.
Nothing.
Yeah.
Like nothing. And so like we have room to drop if needed, but like that is like one that scares me right now. I'm like, what the fuck is happening?
Yeah. And when did you say you bought that?
It would have been late 2023.
That's the worst timing, dude. Yeah. Like that like late 22 to late 23 period. Anyone that's bought anything then is going to be underwater for like a long time. Yeah.
But the problem, my only rebuttal to that is there's a couple comps in 2025 at the low 500s. Yeah. So,
well, even then, right? So if he's at the low 500s, you're what, at 489?
Yep.
Just transaction costs alone, he's losing money on the house. If you take into account the cost that he incurred to buy it, even if he bought it cash.
Oh no, I mean, I don't know. Like, so we bought it $390. He bought it for $40. He took $100K back when we bought it. Saying. I'm just saying, like, we have a loan out there now for what, $375 around there. I don't know.
Gotcha.
And I just it's just sitting, and I'm just like, okay, well, it's a expensive hard money loan to just sit on, right?
Yeah.
So like, okay, how quickly do we price reduce? How quickly do we make concessions? Like that kind of stuff.
I mean, it's death by a thousand cuts. And that's what gets people though, right? That's what takes down companies like ours after a while, because also too, since we have such a long cash conversion cycle, not only do you have those money payments and stuff that are slowly whittling away, but as your revenue starts to drop, just because you're getting less opportunities, less deals, market uncertainty, it becomes like a self-fulfilling prophecy.
Yeah. I mean, let's say you've done this for 2 to 3 years and you've managed to save up a couple $100,000. Don't let one deal ruin 2 to 3 years of hard fucking work.
No shit, dude. No shit.
That would be my, sage advice to anybody that's out there.
Yeah. I mean, and I know that's happened to people, right? I personally know people that were millionaire status 3 years ago that now can barely pay their bills, because like all that money, it went into real estate losses. It went into the tax bills that they weren't paying correctly years ago because they were taking accelerated depreciation. And now they've been selling off properties to pay for their lifestyle, right? And now they're having to pay all these extra taxes and things they didn't account for. And of course, what do dummies do? They sell a property in April and they're like, cool, I got $150,000 out. And they spend it for the rest of the year. And then they get to the end of the year and like, well, you own long-term capital gains plus your depreciation recapture on that. So that $80,000 that you shouldn't have spent, I need that now.
Oh, I talked quickly. That reminded me, I was talking to a newer investor the other day that was at a meetup. And he was basically like, okay, I bought it. I'm buying it for 150. And then we did the BRRRR strategy. I refinanced. And long story short is basically he got like $50,000 back at closing. And when he went to sell it, he thought his capital gains was going to be reduced because he's like, the payoff's now 250 and he only netted like, no, that's not how it works. It is what you bought it for, your cost basis minus what you sell it for. It doesn't matter what happened in the middle of those transactions.
Yeah.
And so I don't know if that's like everyone knows that, like, duh, Dylan, but this guy didn't. So
no, I mean, you'd be amazed at how people don't know that though, right? And I've seen this a lot with people that got refinances in 21 when rates were super low. And so they max cashed out all these things, and now real estate prices have come down, and they're like, "Oh, I got to sell this property. I don't have that much equity anymore." It's like you're still paying gains on that.
Yep.
Like that cash out refinance that you took that you got $100,000 out of that you were stoked on. That's basically you just escalating the gains, like accelerating the gains on that property. You got to pay taxes on that when you sell it.
Yep.
And a lot of people don't even understand that, which becomes very, very problematic.
One thing that's beneficial, at least most of the properties that I am looking to acquire, is my worst case scenario is, okay, I'll take it down now and then rent it out basically. But now if what you're saying comes true, is like, okay, well now the lending environment's going to change and you need to be 70% LTV and it's going to be 7.5%, 8% rates. Obviously that changes the calculation a little bit.
Yeah, exactly. Yeah. On that note, I'll just talk about this very loosely because I don't have all the details yet, but with our hard money lending company, we did get some whispers over a very, very massive like loan mortgage fraud situation that's affecting both private DSCR loans and Fannie Freddie stuff. And I've my information from this is from like 2 short conversations and 2 emails. So I don't know all the details of it, but they're doing huge crackdowns on a bunch of locations, really increasing underwriting status. This is all coming over like the next month or so. And from what I've gathered, it seems like the fraud could be as like several $100 million worth of mortgages. And, with how coy they're being about it, I imagine it's probably worse, than they're actually saying. And, if that comes to full fruition and starts to affect the market here directly, the lending environment could get very, very weird very quickly, and one of the indicators I've had, so I'm working on a couple different loans right now, some like lines of credit and different things on some rental properties. And very strangely, all like for the past like 2 weeks, all of my correspondence, like my, client manager or loan officer or whatever, just like disappeared off the face of the earth. They weren't answering emails. They weren't answering calls. They weren't like participating in the process after I was like sending things. And I was like, where is this? Right. And it directly coincides to when I know the first instance of this whole big fraud situation started to occur. Right. It was 2 weeks ago. And literally like that same day, everyone disappeared off the face of the earth and I heard nothing for 2 weeks. And only yesterday did I start getting like small communications again. And they're moving along kind of like, I would say business as usual. But now they came back with all this underwriting criteria that they want that is significantly deeper than it was 2 weeks ago. And like wanting like all kinds of details on like random stuff. I'm like, I've never even thought about that before.
Yeah.
So,
I mean, this is public knowledge, so I can say it. There's a group in the Cincinnati market called Vision Beyond Properties, and they basically got in trouble with colluding with a title agency who wouldn't record mortgages. And so then they'd go out and get 2-3 loans on the same property. Right. And they basically got millions of dollars. And the one guy I think is, he might be in jail, but there was another one and he like flew back to like India or Iran. He fled the country.
Yeah.
But I don't think that's not an isolated incident. Right?
No way.
I think this is happening a lot.
Oh yeah. I'm sure it's happening at like an even institutional level too, right? With like the really large stuff, especially a lot of these like bigger names that have been getting roasted on these commercial deals that have been getting called. I can only imagine how much fraud's going on there. We have this whole beef in Spokane. So there's this developer here. Anyone in Spokane, this is very public. You can go and you can see me and him get into arguments on the internet and on Reddit. But he's a very well-known guy. And he's like, I know several people that have lost millions of dollars investing with this guy here locally. And there's been a whole bunch of different lawsuits. And it's funny. And after me and him had a little exchange online, his wife got after me and he like texted me and called me and was very upset about the things I was saying. And he's like, well, I want you to know all those people have been, like, not all of them. He said, most of them have been settled by either accepting payments terms or equity on these deals. And I'm like, bro, you just fed them a shit sandwich. Basically, you're like, I lost you your money. Here's what I can do for you. Right. And either way, you're fucked. So he didn't actually solve the problem, but in his mind he did. But anyway, point being, a lot of this came to light because one of the properties that he also owns the business inside of it. It's a very well-known brewery here in Spokane. And the real estate's going to auction, right? Because he defaulted on the loans. And so it's going to foreclosure auction at the end of the year. And I was talking to one of my friends who brought up this really valid point, is like, he owns the business inside of it that's very profitable. How the hell is it going to auction? Is he not paying his loan, right? Because he has full control over the business books, right? And the money. And he is just choosing to not pay the bank back, right? Like, it's not like he has an unperforming tenant or he has an empty property or he has like a value add deal that went sideways. He is just cognitively choosing to not take the money from the tenant that he is and pay his own loan on the real estate that he owns in a separate business.
Do you think he's going to try to renegotiate with the lender?
No, dude, because this is like everywhere. And it's not just this deal. It's like all of his deals. I've heard through the grapevine that there's all these different deals that he has similar structure and that he's defaulting on all of them.
If he's the only collateral, I guess I really don't care if he's losing his own money, but if he's got other people involved, that's when it gets shady.
And I'm pretty sure that's what it is, right? Is he is preserving all that money to try and pay off all these people that are suing his ass.
Gotcha.
Right. The whole point of that, though, is like that's just another case of people doing shady stuff at like a pretty big institutional level, right? And I imagine that's so much deeper than we even realize right now, because like his total portfolio is tens of millions of dollars that's going to be defaulting both with the local bank and then also with all this real estate and all these businesses.
Well, I won't say the name, but I got inside information the other day from a very common syndicator who basically said that if they sold today, their LPs are going to get 10 to 15% of their money, or they could wait 3 to 7 years and get maybe 20 to 40% of their money.
Yeah, that's and if you think of the biggest real estate name you guys can think of, that's probably it. Yeah, that'll be coming out here public really, really soon, which is a shame because some of these ones too, I would say they aren't even necessarily malicious. The guy in my area is definitely malicious. People are doing malicious shit, but there's also people that are just dealing with it.
So I guess, Mike, if we're looking at this, like, I've always wanted to do bigger deals, but I've done, the single families of 4 units because one, there's a higher volume of them. Our off market business is, I won't say easier, but it's more sustainable that way.
Yeah.
But we're going to have opportunities. I think both. How do you guys, or you and Dan have any things like, okay, do we try our hands at a commercial deal if there is blood in the water somewhere, larger stuff, or you're just going to keep your head down and keep doing what you're doing?
I'm just going to keep doing what I'm doing. Right. And like, there was a couple years ago, I was very interested in the commercial stuff, mostly because of higher profit potential. We had some money, I had some more expertise. I joined like a mastermind and stuff for it. And then once I got into it, I was like, this is not for me, mostly just because I don't like how illiquid it is.
Yeah.
Sure. Like I really think that when you are facing a tricky economic situation, you want to be doing stuff that allows you to be as liquid as possible. Because it allows you to pivot, right? Like even people right now that are strictly flippers or, like rental property only kind of people, you need to be realistic about what your property is actually worth and what you can sell it for. Like you were just talking about that cool house you have with the indoor heated pool that has had 3 showings at $490,000. There's a shit ton of people that own properties just like that. And they look at the comp down the street and they're like, my house is worth 500. It's like, well, if no one's going to write you a check for that this week, it's not worth that.
Agreed.
And a lot of people tend to ignore that. And that's where they get into trouble. And commercial real estate is even worse because your buyer pool is significantly smaller. The value of it is heavily based off of the interest rates and the cap rates that you can get for it. But at the same time, I know some dudes like, Drew Wired, good friends of both of ours. He's crushing it with his commercial stuff right now, but he's also doing the most unsexy commercial real estate ever. He's doing like $400,000 warehouses in like New Mexico and shit.
Yeah. Yeah. He's like, riches are in the niches. He's found his niche.
Yeah.
Right? And I guess if you are someone who tracks your net worth, with I think everybody should, just be realistic with yourself on what you think your ARVs are on the properties that you own. And if it is a commercial building, in bad economic times, cap rates go up no matter what. Like that's just as a fact.
Always. Yeah.
So if you think earlier that you bought this place in a couple of years ago and then trade a 6-7 cap, it might be 8 or 9 now, which on a couple of $100,000 of NOI is a huge difference.
It's huge, right? That can be your entire deal. Like all of your profitability, especially if you raise money as a GP, you're left with a situation of either you pay back your LPs if you can, and you walk away with nothing, or you just steal their money and you go be a crook, like half the people seem to have done.
Well, even I think I mentioned to you, it wasn't on the podcast, but I got an off-market opportunity for 25 units in a sub-market here of Cincinnati, which is a popular sub-market. And we were trying to sell them at 75 a door, which a couple of years ago would have flew off the shelves. Yeah. Like it would have been like, and I've not been able to move it. And all my biggest buyers are like, no, I'm good. And it's almost like they don't even not like the deal that much. They're just like, hey, man, I'm too nervous right now.
Yeah, like totally. And that's an important thing to understand, this is also why I'm really into our lending business right now, is because it's shorter term. We get to have additional room on their leverage that they're already taking, right? On their space they've already created. And then, we get personal guarantees and those sort of things. And so they can take the risk and we have like extra collateral if needed. But that's another thing too, like if you are interested in real estate and you like paper is relatively liquid, right? Because you can sell notes a lot easier and quicker than you can sell real estate because there isn't as complex of a title process, but yeah, I don't know, man. It's like it's a tricky sort of thing right now. And it's funny. I feel like we've been talking about like what's going to happen like for years. I do feel like we're at a position where we're kind of at a tipping point, an inflection point. And I don't know, like my biggest guidance for people is just do stuff that allows you to be mobile and stay liquid and focus on deals that are, I would call like near certainties and not ones that are speculative because there's not time to be doing anything speculative.
Yeah. Don't chase. Like I was guilty of this. Like I said publicly on the podcast, like, okay, I wanted to do $1 million top line this year. And by numerically, we're still like barely on track for being through 6.5 months of the year, 7 months of the year. But I don't want that to be like a pressure to chase a bad deal.
Exactly.
Right.
Yeah. Totally.
Like,
I mean, that's why I'm not big on like setting financial goals like that either. Cause I feel like people make dumb decisions by it, right? Like if people set these lofty goals that are based purely off of numbers or like ego goals, it leads to two things. They either cap themselves unintentionally because they set a goal that's definitely achievable, or they are chasing something for kind of no reason and they make poor decisions as a result.
And I found myself like having somewhat like mental anxiety of like, I'm not going to hit this. I'm like, I'm still doing better than last year. Like, like it was just kind of like, why am I? It was like mind games almost. And so like I needed to have like a almost come to Jesus system up there to like, it's okay if you don't hit it because you're still like kind of doing very well in this business.
Yeah, exactly. And look at like your big picture, right? And be realistic about what your financial situation is and everything else. Because after a while too, once you make money to kind of have your lifestyle, you don't need to keep making money. Right. Like realistically.
Right.
It's good to like have additional money for opportunities, or if you want to buy something in the future, you want to escalate your lifestyle, but that doesn't mean to do it like today,
Yeah, totally. Real quick while we have it, just because this is going to be top of mind in the next like week or two, the Fed does meet on 7/29 and they'll have a decision on 7/30 if they're going to cut rates or not. Some latest like economic data just came in. It's called the PPI, which is basically the CPI for manufacturers. Like how much did their products like raw materials increase in price and whatnot. And it was relatively flat, both month over month and year over year. So that would indicate like they're less likely to lower or raise rates. Like why change anything if the inputs aren't changing, right?
Yeah.
And so it is forecasted right now of no rate change at the next meeting. The Fed does publish what's called a dot plot, which is their own like internal barometer of what they think rates are going to be. And they do think for 2025, the median should be like 3.9, which is currently trading at, this is the Fed funds rate, 4.25 to 4.5, which would indicate still 50 basis points cuts through the end of the year.
Yeah. But the thing is tricky now, and this is where a lot of people don't understand because their entire, I would say, knowledge base or experience with interest rates was in 21 when there was always like, are they going to drop them again? And now we're at like 2%. It's crazy. Mortgage rates don't necessarily have to follow the federal interest rate.
And it hasn't.
Right?
Really.
It hasn't. Since 23, since they stopped buying
MBS. Mortgage
MBS. Yeah. So that like, and realtors, you can tell the newbie fucking realtors that took the whatever Keller Williams stupid class around like how to get your buyers to, get off the toilet and buy a house. Because they're always posting about like, oh, the Fed rates are going to come down. So it's time to, get in your loan application. That's not true.
Right.
Because like there has to be a buyer for that debt, and the US government's no longer buying it. And then no one is buying US debt in general. So even if they do lower rates, it'll make, it'll allow the banks to bail out of some of the shit that they're in. But it's not really going to trickle down to the rest of us, I don't think.
The one, I don't want to butcher this because I'm trying to remember what I heard on a podcast, but we've talked about the K-shaped economy on here, whereas wealthy people versus, people not doing so well. When the Fed's funds rate is higher, a lot of money market accounts with wealthy people can just throw millions of dollars into a money market account that's paying 4.5%, 5%. Now, money market rates do follow the Fed's funds rate a little bit closer than like a 10-year treasury would. So they're theorizing like, okay, if that does actually come down to, let's say, the mid threes, well, that money that is in those money markets accounts might go chasing yield somewhere else because now their yield is going down. But again, that's just rich people buying assets again.
It is. Yeah. Which is, already the recurring theme that we're seeing. That's why, we have a massive period of economic uncertainty, but the stock market is still sky high, right? Because you have these people that are selling this real estate and everything else, and they go, what the hell do I do with my money? I'll just put it in stocks because that's doing good right now, right? And it becomes like really promotes the Wall Street slot machine even more because people are just taking the wealth they've accumulated elsewhere and dumping it over there.
There was an article out there that they're going to try to incorporate private equity offerings into 401ks the other day. I'm just like, that is the worst idea I think I've seen in a very long time. 100%. Illiquid, the returns are not great, and they're like it's a box. You don't even know what the returns are until basically the thing is sold. So that I was not happy when I saw that. But
yeah, well, I mean that's just them trying to open up all those 401k funds to the people that want to exploit that money and do weird shit with it. But anyways, cool. Anything else, Dylan?
I think I'm good for this week.
Yeah. All right. Cool, guys. Well, thanks for listening. Go and tell your friends that, you've had this real estate business economy show that's pretty good sometimes and you learn stuff. And sometimes you're entertained and sometimes you're not, but that's your problem. So, all right, guys, we'll talk to you guys next week and have a good one.
See you guys.